Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites JugglingDynamite.com and VenablePark.com. Welcome back to the show, Danielle.
Thank you, Jim, from very snowy Ontario.
Well, it's from very wet British Columbia. Abbotsford is still flooded, and the floods happened a month ago. Vancouver only has one narrow, twisty, two-lane road to connect it to the rest of Canada, so that's restricted to essential traffic only. And gasoline rationing is still on in Vancouver due to the floods. So although it's not on the national news, it's still happening here.
Rough. Sorry to hear that.
We're getting by. As you know, we're Canadians. We're tough. Danielle, years of financial regret priced into risk markets. What does that mean?
Well, the statistics today, it's hard to be hyperbolic. I've said this before. It's in this world of its own dreaming. The valuation on market assets today is literally off the charts in pretty much any way it can be measured. And I feel like a broken record because it just is crazier and crazier as each month passes. But the fact is that if we don't take measurements and we don't try and get some bearings on where we are relative to value, relative to historical norms, that really is the only, it's kind of like we're walking in a snowstorm, Jim. That's kind of what it's like. And you need to have some kind of a rope tied to your doorknob to get back to your house, because otherwise it's so opaque. Complexity is the mother of deceit and of mass confusion, and that's really what we have today in spades. So, most people just measure their financial prospects or whether the market is positive or not by price alone, just pure price move. If something's gone up, they think it must be worth more. They assume there's some legitimate reason for that, or that it's wealth creation and all this sort of thing. The problem is that when we have assets rising in an environment which is highly levered and highly untethered from rational underpinnings, you have this very amorphous environment where we've seen this so many times before in the last 20 years, where prices climb an awesome amount only to collapse completely and give back years of what people thought was growth. And we see this on just if we look at things like the benchmarks, just the S&P 500, the Dow, the NASDAQ, the TSX, these things that people look to for insight on whether, financial conditions are good or bad, for example. It has become this very unreflective indicator of economic stability or health, because it has become so juiced by speculative principle and money that's hot flows moving around and gambling money, basically. So when you look at the S&P 500, for example, since 2011, when Bernanke really doubled down on, if you recall, he started this QE, the bond buying, they'd already slashed rates to 0.25. Then they noticed the economy was slowing again in 2010 after the 2008 recession, so they panicked and they decided they wanted to try and, more to the point, asset markets weren't rebounding sharply after 2010. They were starting to drift sideways. They started to fall again in 2011. And so the central banks decided that they needed to really double down on more of this asset buying. And indeed, if you look at what's happened to stock prices since then, There's been this remarkable climb, especially in the last year, as you know, since the pandemic hit and more funds went into financial intermediaries. But if you look at what's happened to the underlying, like what are people getting for the dollars they're spending when they're in stocks at these levels, you realize that most of it has come from companies buying back their own shares. So this has been companies flush with liquidity thanks to central bank injections and low rates, where they've been able to borrow handily and easily at record bottom rates from investors. They've turned around and funneled trillions of that into buying their own shares, and it's a way to, in the short run, elevate price of the actual securities, but in the longer run, there's a great cost, right? Because now they have literally diverted funds from other more productive pursuits. We've talked about this before. Instead of investing in their own productivity or paying down their leverage and, building their stability for the future and innovation and all that stuff, instead of doing that, they have in fact weakened their future prospects on a quick hit to their stock price in the short run. And the underlying components of that are, much, much smaller. So people think that there's been a rebound in earnings over the past 10 years, but just 7% of the increase in price has come from 7% has come from an increase in dividends and about 30% from this rise in prices, in profit. So if you backed all that out, you would just find that stocks have actually been flat, reflective of a weak economic environment, which we've indeed had, of 2% growth over the past couple of decades. And all of that is really kind of in line with the norms. The long-term annualized return on stocks has been the dividend plus a couple of percent for inflation. Well, because prices have been so high, the dividend yield, for example, on the S&P today is 1.2, but basically it's been in the 1 to 2% range for the last 20 years, except at market bottoms in, for example, 2003 or 2009, when you could buy at 50% discounts to the prior peak, and that's when you get a dividend yield that's like 4% or something worth owning. But in this environment of extreme bubbledom, you've got very low dividend yield and very low economic growth because it's been such an unproductive use of capital in this environment. And so the point of all this is the mean reversion ahead suggests that we're going to see something like the S&P is presently 60% plus ahead of its long-term average trend line in terms of its growth. So when you see that historically, and I put on a chart going back to 1870, when you see the exponential growth line there of the broadly followed S&P 500, you see that we're 60% above that trend line, and we've never been that far above it in the last since the 1800s. But in previous episodes, which were very fleeting, whether they were 1929 or 1969 or 2000, 2008, we were above that trend line to a lesser degree, but you see that prices then mean reverted in a very dramatic fashion, well below the line, and labored there for years, Jim. So the point of all this is that we've done everything in our power to goose asset prices in the short term. That's been longer term very counterproductive, and it means that financial risk today is the highest it's been since about the 1800s. I mean, probably higher than that. We don't have data back any further than that. So it really just shows you, why is the NASDAQ that, for example, the Russell 2000 is supposed to lead, that's the small cap index, is supposed to lead the larger market indexes if you're talking about a sustainable economic recovery prospect spreading through the wider financial picture. And actually the Russell has been flat now since February for about 10 months. It's gone nowhere. At the same time, we've had this 5 FANG stocks, the Facebook, Apple, Amazon, Netflix, and Google have elevated the NASDAQ to a record multiple of the Dow. So we have never seen, it was to a lesser high relative to the Dow, the NASDAQ was at the peak in March of 2000 for a very short period of time. And then, of course, it tanked 78% thereafter, that index, that tech-heavy index. And today we see the same thing where these 5 heavily concentrated tech names are so insanely valued right now. So much money has gone into those, stars, as it were, that for example, the market cap of Apple today is higher than the market cap of the entire Canadian stock market. The market cap of Apple is about $1 trillion higher than the entire GDP of Canada, but not just Canada. It's about the same as the UK, India, France, all these major economies. We've got this one share. So the Dow has Apple in it. It doesn't have the other FANGs, but the NASDAQ has these 5. So people think those stocks are infallible because they have performed so dramatically to the upside during this climate. But we know that tech is a cycle. We know that stock markets are cycles. The credit market is a cycle. And in fact, high yield debt, for example, is again flat for the past few months, has not made any higher highs in this environment. The TSX has been flat since October. And all of this is really just to say that there is a lot of fundamental reasons to think that the market top may indeed have already been in for the major indices, that we're now in the decline period that has been deferred and deferred and deferred by all the central bank intervention and psychology, which has been swayed by a belief that central banks somehow can levitate assets indefinitely. But when you look at the M2 money supply, for example, which is the product of the interventions, the liquidities, the QEs funneling into financial intermediaries, it is plunging. It's been falling since about May of 2020, and indeed the Bank of Canada has stopped the bond buying. The feds in the U.S. now think that they've been tapering already, but now talking about tapering even quicker. And now the bond market, the treasury market, actually was pricing in a bunch of hikes in 2022 because of this recent spate of inflation, which we've discussed and which I've maintained throughout was not long for this world. Because when you get this kind of price inflation for these anomalous reasons that we've seen in the last year or so, you get a decline in real income, right? So income has been pinched. Disposable income is less now that prices have gone up and housing is so much, for example. And when you have that fall in real disposable income, you have less spending ability, and people have been relying on things like equity withdrawals from their home because they feel that they're wealthy because assets that they do own, the people that do own assets have gone up. Again, if we look at that metric, the actual household net worth as a share of disposable personal income today is about 790%, when the long-term average over the last 30 plus years has been 597%. And, at the peak of the tech bubble, it was about 620. At the peak of the 2006-07 housing bubble, stock bubble, it was about 660. Well, we're 790% today, assets above disposable income. So when you, no longer can count on that gravy train, right? If prices just don't continue to rise, never mind correct, if they don't continue to rise, that really negates the ability of people to borrow more against their stocks on margin, which they've been doing. We have all the data to say that's been a major driver in terms of spending in the economy, and also from their homes, this whole equity withdrawal stuff. I mean, the amount of craziness that's going on in housing and people using debt to fund spending has been just bonkers, Jim. And it's never going to end well. It never ends well. It is always just typical human behavior. And so the point of it all is that this house of cards that's been built on these highly levered, over exuberant pricing is not a stable one. And our economy and our household net worth, our ability to spend everything is now predicated on this teeter-totter. And indeed, when prices come back down, I think we're going to be in for a painful payback period.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, how do you think this financial cycle will end?
Well, it's impossible to know exactly how, but it's pretty clear that it will end in a typical fashion, I think, eventually. In other words, you can't have this amount of insanity, of uneconomical decisions and allocations go on indefinitely, they always have a sort of a deflating impact on themselves eventually. I think back to when for example, in 2018, there was great optimism. The Trump tax package was supposed to, the tax cuts were supposed to, reflate the economy in a really dramatic fashion. They were promising all this great growth and everything to do with that. And what we saw was that, commodity inflation picked up because this typical thing, a bunch of speculators decide to start buying goods and the components of goods on the expectation that prices may rise. And the Fed started to hike rates then, and they got to they'd been hiking actually for a while, but they got to 2.5 in December of 2018. And, we had a taper tantrum, a big sell-off in the stock market, if you remember, in December of 2018. And by August of that year, the Feds were back to cutting rates again because growth had come off so sharply and everyone was so defeated because their stock portfolio had declined really rapidly. So I think that at this point, there's all these the expectation for hikes in 2022. I'm much less inclined to think they're going to do much in the way of hiking. They may get a one or two in there, but any price or any increase in yields in this environment is going to be a problem for so many highly levered companies and individuals, and the spending, as I say, that has been going on there. So just any kind of increase is going to be an economic drag. So that makes me think that we aren't going to get far into the hiking cycle. And indeed, I think the bond market agrees with me. And when I say the bond market, I mean the treasury market. And we need to make a distinction there because so many people don't. They talk about the bond market as if corporate debt and treasuries are the same thing, when in fact they're entirely different animals. Corporate debt, of course, being something issued by companies that one loses if a company goes bankrupt, that decline in price if a credit rating falls, that sort of thing. That is an instrument issued by corporations that typically trades with the equity cycle. So corporate bond prices rise with equities, and therefore the yields on them fall, and that we've seen in spades the past couple of years when people were basically lending money to companies, even really sketchy companies, for the least compensation ever in human history, which was not a good investment decision. It was just fear of there's no other option, what should I do? Allocators with cash thinking, well, I can't just put them in safe instruments because they won't think they're making enough there, so I've got to find them riskier things to buy. So a bunch of capital flowed into all those things. But if we look at the treasury market, which is the government bond market, where governments, I always like to point out, are one of the only entities that can actually increase their revenue by hiking taxes if necessary, whereas individuals and companies don't have that kind of mandamus when it comes to their income, right? They have to kind of deal with the conditions they're in, whereas the governments have more ability to tax and raise capital that way. So anyway, they're a different beast, and the treasury market is also one of the few asset classes in the world that moves in a negative correlation to all these other things. So whether it's cryptocurrencies, which, by the way, Bitcoin is now off about 27% from its high in November, and the whole crypto space is going through its, 75th nervous breakdown. But anyway, if you look at that, it's a risk asset. It trades with the risk, other risk assets like commodities, like equities, like emerging market, debt. All that stuff tends to move in the same cycle, whereas treasuries look forward. And if you notice what's been happening in the last while, is rates actually peaked, treasury yields peaked last spring when there was this expectation that all the free money in the economy was going to really supercharge an economic expansion cycle and consumption. And it did indeed, as we spoke before, supercharge a good deal of goods consumption, durable goods consumption in particular, and activity in housing. But since then, we've seen treasuries, especially U.S. treasuries, have not made a new high since last spring and indeed have been trading lower. Canadian yields have also been trading lower of late, which means fund flows are coming into government bonds. That's what that means. When prices rise, the yields fall. That's international fund flows. Why? Well, for one thing, relatively, the yields in North America are much higher than other countries, and indeed, also, when you have something like a strengthening U.S. dollar, which we have had since about June, the year to date, the DXY, the index of U.S. dollars versus other trade currencies, is up about 7.6%. But since June, it's come up significantly. And since then, it's up against the Canadian dollar as well. So when international fund flows are looking for somewhere to be that's not just a complete crapshoot, that they realize the world has been in this artificial state of stimulus and is now in the declining phase both of growth and inflation, they look for somewhere to put capital where it is secure, where it can earn some yield and hopefully some capital gain as well. So when they're putting it into something like a U.S. Treasury, they're getting the currency increase, capital gain, as well as the potential for prices to rise and yields to fall. So that has in fact been happening, and that's why I like to point out that treasuries are one of the few safe havens relatively in the world. They trade in negative to the risk trade. In other words, when the risk trade starts to fall, when all those assets start to go down, you have no diversity holding baskets of all those things that are highly correlated, but you can have some diversity in terms of rising assets versus all those things in the form of North American treasuries. So that has in fact been happening. The other thing is they have income flow that comes off and that can be reinvested and compound on a regular basis. And for that reason, it's very little known, but treasuries have actually outperformed stocks by a huge margin, by more than 3 times since 1980. And that's very little described or explained to people because the industry has a vested interest in trying to get people into corporate products, right? Whether it's commodity-based or crypto-based or equities or corporate debt. These are where the underwriters come in and make all the fees. So they float all that stuff to people as the only option for their savings when in fact there's these other things that actually are much more intelligent and safer in this environment. I'm not saying forever and always. I'm saying in this environment, when you've got such insane risk in so many of these asset classes, this is one of the few places that you can look to put some capital that will not just, lose 50 to 70%, which is how stocks are priced today. And will actually allow you some liquidity. So, things like cash, I've mentioned this before, cash is not trash, cash is optionality. Cash is one of the most important things in a deflationary environment, and everybody is trying to tell you that cash is trash because of this loss of purchasing power. What I'm describing is a deflationary environment where prices are starting to come down, where asset prices ultimately crash by a great amount. That's when the people with cash then can put it to work, and get great yields and get good capital return prospects with a fraction of the risk of the present environment. But unless people set aside some cash, they won't have any optionality on that or ability to execute. Indeed, they'll be selling in panic instead of buying in strength.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim. Good luck to everyone.
My guest has been Danielle Park, editor of Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Check out our websites, jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.